Hi, and welcome back to Heimler's History Economics Edition. We've been talking about money in the last few videos, where it comes from and how it's regulated. In this video, we're going to learn two models for understanding the supply and demand of money: the Liquidity Preference Model and the Loanable Funds Model. Let's get to it. So we're going to begin by talking about supply and demand as it relates to money. And when I say that, you might grow a question mark over your head. What do you mean supply and demand for money? Isn't there just a set amount of money in the economy? And if that's your question, then I have an answer for you. No. You see, it's the Federal Reserve who uses its economic dark arts to decide how much money they want to have in the economy and how much money they want to have out of the economy. Now, in the supply and demand graph that you already know, and if you don't know it, there are videos linked below that will make all your dreams come true. People demand more or less of a good depending on how the price changes. And the same is true in the market for money. As the price of money increases and decreases, people demand more or less money. The price of money? What you talking about? Son, you sound crazier than a dog in a hubcap factory. Granted. But money does have a price, and in economics, that price is called the interest rate. And the interest rate is what it costs to borrow money. So if the interest rate is 10% and I borrow $1,000, then that means in a year I'm going to have to pay back $1,100 because 10% of 1,000 is 100 and 1,000 plus 100 is $1,100. So in that example, it cost me $100 to borrow $1,000. Does that make sense? Well, I don't know about y'all, but I'm about as confused as a fart in a fan factory. I think I know what'll clear it up. A graph. It's graph time. Behold the money demand curve. Now here on our y-axis we've got the interest rate, or R. And on our x-axis we've put the quantity of money. And just like the regular demand curve, the money demand curve is downward sloping. And the reason why it's downward sloping is because as the interest rate rises, the quantity of money demanded decreases. And as the interest rate decreases, the quantity of money demanded increases. And just like the regular demand curve, the money demand curve can shift to the right or to the left. When it shifts right, that's because more money is demanded at every interest rate. And when it shifts left, that's because less money is demanded at every interest rate. Now, what is it that causes the money demand curve to shift? Well, there are three things. First, the money demand curve will shift because of changes in the aggregate price level. Or, say it another way, the demand for money is proportional to the aggregate price level. As the price level rises, more money is demanded, and that shifts the curve to the right. But when the price level decreases, less money is demanded, and that shifts the curve to the left. The second factor that can shift the curve is changes in real GDP. An increase in real GDP shifts the curve to the right because if output increases, people need more money to buy those goods. A decrease in real GDP shifts the curve to the left because there's less to consume and therefore less money demanded. The third reason this curve shifts is because of changes in technology. Now that technology has advanced so far that we can swipe cards without having money, we demand less cash, and that has shifted the curve to the left. However, if someone suddenly broke the internet and the digital flow of money ceased, it would increase the demand for money, shifting the curve over here to the right. Okay, now that we understand the demand for money, let's add the supply curve. And you see that the money supply curve is vertical, and that's because the money supply is unresponsive to changes in the interest rate. It's the Fed that decides how much money goes into an economy, and if the Fed decides that it wants lower interest rates, then they will supply more money. And if they do that, that will shift the curve to the right. The money supply has increased. And as you can see, our original interest rate was right here, and our quantity of money was here, and if the Fed increases the money supply, that actually lowers the interest rate to R1 and quantity 2. On the other hand, if the Fed wants to increase interest rates, they will decrease the money supply and shift the curve this way. And as you can see, that will raise interest rates to here and decrease the quantity of money to here. And this is called the Liquidity Preference Model. Now, how is it that the Fed increases or decreases the money supply? Well, I've got another video that explains what the Fed is and what the Fed does, and if you want a deeper explanation, you can go see that one. But for our purposes, it's enough to know that the tool that the Fed most often uses to increase or decrease the money supply is open market operations. And that's just a fancy word for buying and selling bonds. If the Fed wants less money in the economy, they will sell bonds. Because if they do that, money is being exchanged for bonds. Now there's money at the Fed and bonds in the economy. If the Fed wants more money in the economy, then they will buy back the bonds, because when they do that, they have the bonds now, and the money money is now in the economy. So that's the liquidity preference model of money supply and demand. Now I want to introduce you to another model for the supply and demand of money, the Loanable Funds Model. The idea of loanable funds just basically refers to the meeting of savers and borrowers in the financial market. Recall that it's savings which creates the pool of funds which banks then loan out. Now these two models are related, but let me show you this one by itself, and then at the end I'll show you how these two models inform one another. And we're back to the graph. So here's the graph for demand for loanable funds. On the y-axis we have the interest rate, and on the x-axis we have the quantity of loanable funds. Now I have to stop for a second and mention something important. The interest rate that we're dealing with here is not the real interest rate, but the nominal interest rate. The real interest rate will be adjusted for inflation. The nominal interest rate is not adjusted for inflation. And the reason why we use the nominal and not the real interest rate here is because remember, when somebody borrows money, they are expected to repay it in the future, and no one knows for sure what the inflation rate will be in the future, so we have to settle for measuring prices with the nominal interest rate. So as I mentioned before, the interest rate is the cost for borrowing money. So if the interest rate is higher, say 12%, then fewer households will demand money, and our quantity is here. In fact, they'll only borrow money if their rate of return on a given project will yield more than 12%. On the other hand, if the interest rate is lower, say 4%, you can see here that households and businesses will demand more money. Okay, now let's add the supply curve. Now the supply curve is upward sloping. Remember that the pool for loanable funds exists because people save their money in banks and invest in bonds and stocks, etc. So when the interest rate is higher, say 12%, that means people have the potential to earn a lot more by loaning out their funds, and therefore they will supply more. But when the interest rate is lower, say again 4%, they don't have as much incentive to save, so they supply less. And of course, I would be remiss if I didn't mention the magical happy town of equilibrium. Here, the quantity of loanable funds demanded equals the quantity of loanable funds supplied. And the reason why is because the equilibrium interest rate provides the occasion for everyone who really wants and needs to save money and borrow money to get it. Now both of these curves can shift all over the place, and let's look at the demand curve first. The demand curve for loanable funds will shift for two reasons. The first is changes in perceived business opportunities. Like in the 1990s, when businesses began to see the dominance of the internet on the horizon, they borrowed tons of money and shifted the curve to the right. But when opportunities look bleak, that shifts the curve to the left. Second, the curve will shift because of changes in government spending. When the government runs deficits in its budget, that means it needs to borrow more money, and the curve will shift to the right. And just so you know, there's a term for this, and it's a concern for economists, and they call it crowding out. It means that the government is borrowing money at a higher rate, and that crowds out businesses who want to borrow money. But if the government is running a budget surplus, then it can shift the curve to the left, since the government demands less money to borrow. And wouldn't you know it, the supply curve for loanable funds can shift as well. The first reason it will shift is because of changes in private savings behavior. If the economy is good, people in general will feel richer, and that means they will spend more and save less, and that will shift the curve to the left. And will shift to the right when people feel strapped for cash and spend less. The second reason the supply curve will shift is because of changes in capital inflows. Now, capital inflows just means all the money that comes into the country from outside investors. If other countries see that our economy is doing well, they will invest money into our economy for the purpose of loaning it out at interest. When things look good, that increases our capital inflows and shifts the supply curve to the right. When things look bad, that decreases capital inflows and shifts the curve to the left. And depending on where these shifts occur, they will all eventually lead us to a new equilibrium rate. Okay, now that we've learned all that, I need to introduce you to something called the Fisher effect. But let me lay some groundwork before we get to the graph. Now, earlier I reminded you of the difference between nominal and real interest rates. Real interest rates are adjusted for inflation, nominal interest rates are not. So suppose a firm takes out a loan for $1,000 at 10% interest. That means that at the end of a year they need to repay that loan plus 10%, so that's $1,000, the original loan, plus 10%, $100. At the end of the year they need to repay $1,100. But suppose during that year price levels increase by 10%, which means the inflation rate is 10%. And since the real interest rate would equal the nominal interest rate minus the inflation rate, the real interest rate over that year is actually 0%. So in terms of real interest rates, this firm just got a loan at 0% interest. Got it? Okay, let's look at a graph. So this graph shows the supply and demand for loanable funds if the expected rate of future inflation is 0%. So let's say the equilibrium interest rate is 4%, and here is our quantity at equilibrium. But suppose that the expected rate of future inflation is 10%. The Fisher effect tells us that both curves will shift upwards by the amount of the expected inflation rate. In this case, it's 10%, so we'll be here at 14% because 10 plus 4 is 14. And now we have a new equilibrium here. But notice what happened. The nominal interest rate has increased by 10%, but the quantity of money supplied and demanded has not changed. And the reason is because the same amount of funds will be supplied and demanded at the higher nominal interest rate. Why? Because even with the increase in nominal interest rate, the real interest rate remains unchanged at 4%. The reason is because the real interest rate equals the nominal interest rate minus the inflation rate. So the nominal interest rate is 14% minus the expected inflation rate equals 4%. Okay, if you've stayed with me for this long, then you're either a glutton for punishment or an economics genius. And in either case, I hope you'll stay with me for one more step, because what I'd like to show you now is how the Loanable Funds Model interacts with the Liquidity Preference Model. Okay, so here are two graphs side by side, and let's look at how they affect each other first in the short run. So notice that both models are in equilibrium. At this interest rate, we're in equilibrium here and equilibrium here. So for the model on the left, at this interest rate, the money supplied equals the money demanded, and on the right, the same interest rate means that the loanable funds demanded equals the loanable funds supplied. So let's say that the Fed increases the money supply from here to here. In this case, the money supply increases and the interest rate decreases. Now, how does that affect the loanable funds graph? Well, at the decreased interest rate, there is more money in the economy, and that increases real GDP, and that corresponds to an increase in savings because of the money multiplier process, which is to say more people will put more money into the bank, and that increases the available pool of loanable funds and therefore increases the quantity of funds demanded. And this shifts the loanable funds supply curve to the right. So the Liquidity Preference Model determines the interest rate for both markets in the short run, but not so in the long run. In the long run, changes in the money supply don't change the interest rates. In the long run, here's what happens. And by the way, if you need more explanation on how things work in the short run and the long one, you can watch my video on equilibrium in aggregate supply and aggregate demand. So if these same movements that I just illustrated on these graphs happened in the short run, we know what's going to happen. But here's what's going to happen in the long run. The interest rates will decrease just like we saw, but in the long run, the aggregate price level will rise. And that will shift us right back to the original equilibrium. And the same thing happens to the loanable funds market. In the short run, the interest rate decreases, leading to an increase in real GDP. But again, as the aggregate price level rises, the interest rate rises too. And in the long run, when that happens, savings decrease, shifting the demand curve back to the left and back to this original equilibrium point here. Son, after all you just said, I got a head full of stump water. Fair enough. I'll leave it there. I'll see you next time. Thanks for watching yet another in the installation of the pantheon of Heimler's Histories videos. If you're new here and found yourself help, then subscribe and I'll keep making videos for you. And if you want to increase the demand for this video, then hit the like button and let YouTube know. Bye.